PayPal just reported earnings, and there were some shocking surprises in these numbers. Now, in this video, I will take you through the numbers because, well, in a prior video, I explained that I expected PayPal to beat the expectations, which they did handsomely, and especially on one metric. Now, I will explain you what this metric is in a second. So this will be just a quick video. I don't have too much time. I have to run. So I wanted to get this out as soon as possible because I'm really happy with the results. And I'm so happy with the results. I'm going to take you through the numbers first because I started working on this video already before the investor presentation came out. Now let's just dive straight into it. Because when we look at the Q2 24 financial results, we can see a total payment volume growth of 11% year over year. This is good. We see net revenues up 8%, precisely in line with expectations, and transaction margin dollars that was up 8% as well. That's a bit of a surprise already because that has been trailing the revenue growth. So that's very good. We see operating income increase by 17%. Now, this is way more than expected, and we see the operating margin increase by 126 basis points. This is fantastic because the margins they just had to increase. They had to improve. This was partially the job of Alex Chris, and so far he's coming through. Now we see earnings per diluted share on a GAAP basis increase from 92 cents to $1.08. So that's 17% EPS growth. EPS growth is far outpacing revenue. So that's, again, fantastic. If we look at the non-GAAP numbers, we see operating income increase by 24% and operating margins increase by 231 basis points. Now, that can be due to some one-time expenses that have been taken out on non-GAAP margin or numbers. And we see the earnings per diluted share increase from 87 cents to $1.19. Now, the expectations was for about $1 of EPS, of non-GAAP EPS, and they came in with $1.19. They beat non-GAAP EPS numbers by an incredible margin. It was up 36% year over year, and this is excluded stock-based compensation or included stock-based compensation. Now, if we look at the guidance, we can see that, we can see the July 24 guidance, the April 24 guidance, and then how that compares to the prior year. And the most important part is the full year 24 guidance, which I want to take you through, because the GAAP EPS numbers is now expected at a midpoint of $3.93. And that is up from $3.65. So that's up by about 7.67%. So that's a very good increase. Non-GAAP EPS growth is now expected to be low to mid-teens, where it used to be mid to high single digits. So that improved a lot as well. The guidance has been taken up immensely. Now, if we go through the income statement, we can see that the net revenues was up 8.21%. Transaction expense was up 11.32%. So that's still a slight negative. The transaction expenses are increasing faster than the revenues. That's not really what we want to see. But the total operating expenses were only up by 6.6%. So the total operating expenses, they are increasing less than the revenue is increasing. Now the operating income up by 16.95% and the net income by 9.62% for when we compare it to the prior year. So this is all very good, except for maybe the transaction expense. And we have to keep that in mind because we know with PayPal analysts, they are searching for the negatives. They are not looking at how good this business is doing. They are looking at what is not good about the business. And the transaction expense increasing faster than revenues, that's not really a positive. Now we can see net income per share on a diluted basis, the GAAP number, up from 92 cents last year to $1.08 this year, or 17.4% increase. And we can see that the weighted average shares decreased from 1.11 billion to 1.04 billion, or a decrease of about 6.4%. Now, I'll come back on this later in this video because there's a very good development going on there. Now then we also have the stock-based compensation, which was simply too high. They did too much with stock-based compensation. And that's also why the new management said we're going to take this into the non-GAAP EPS numbers, because we need that accountability and we need to be more transparent about it. Now, when we see the stock-based compensation compared to the prior year quarter, this is down 20.5%. And this is including the restructuring cost. So overall, this is down even more than 20%. So that's simply incredible. That is very, very good to see. They had to do something about stock-based compensation, and they are doing something about stock-based compensation. And that's even more important if you consider the amount of buybacks they are doing, because they are diluting their own work with it. So they are battling that stock-based compensation and that outstanding share problem on two fronts, basically. Now, then we just have to look at the active account numbers, because this has been trending down slightly as well. And if we compare it to a year ago, it's still down slightly, but it's higher than the prior 3 quarters. So it's a bit of negative, but with a positive twist. Now we see the number of payment transactions, and this is up 8% year over year. And that's slightly less than we have seen in prior quarters as well. So this is why I'm trying to highlight the negatives, which we know analysts will be looking for. Now the payment transactions per active account are now at 60.9, up 11% year over year and 2% quarter over quarter. I guess that's quite positive. Now, what we want to see, and why I think we have a surprise in these numbers, and what is a very, very positive surprise, and I cannot understate how positive this is. We see the transaction margins at 45.8%. And in the initial shareholder letter, or in the initial release, Alex Chris also states that this is the largest increase in the transaction margin that we have seen over the past few years, since 2021. So this is very good, and this is what analysts want to see, because this is one of the main bear points of this stock. And all that analysts or the new management, basically the main task from management is to take out the bear cases, because there have been too many for PayPal. Now, while I was making this video, the slide deck came out, the investor presentation came out. And what I want to look at here is they say it's strong execution on transformation. And it truly is. What we see is building foundation for durable, profitable growth. We see that in the last few reports. We cannot disagree with this. Branded checkout, Braintree, and Venmo contributing to highest transaction margin dollars growth rate since 2021. This is what I just alluded to. Driving consumer momentum with monthly active accounts growth across PayPal and Venmo. We saw that it's the highest it's been in the prior 3 months. So that's very good. And they reinvesting cost savings into growth initiatives such as checkout, omnichannel, and the ads platform. The ads platform is one of the more important things for the future. Now they are raising full year guidance for the transaction margin dollars, EPS, free cash flow, and share repurchases. They are just raising the guidance all across the board. And we know that they have been setting themselves up to do so, but to see it is very good. Now they are also focusing on best-in-class checkout to optimize conversion, fast lane general availability in the US in August, and expanded partnership with Meta and DoorDash. So they are really going after this fast lane opportunity, and they are going after it quite aggressive. Here we can see that early fast lane on the left bottom, early fast lane results achieving about an 80% conversion for returning users versus an industry average cash checkout conversion of 50%. So Fastlane is really contributing a lot for the customer of PayPal and for the conversion rates. So that is very good to see, because this will only mean more growth for PayPal, what we want and what they should go for. But these numbers, we now have the concrete numbers. This is really impressive in my opinion. Now they are going to bring Fastlane to the market. The part above it, general availability in August for all US merchants on Braintree, PPCP, and key partners. So they are rolling it out quite aggressively in this quarter. So we will see the first numbers come through in Q3, and in Q4 it will be rolled out mostly in the US. And they are driving monetization from Venmo. This is something we want to see because Venmo has been a bit of a pain for PayPal. And Venmo debit card and Pay with Venmo monthly active accounts is up by approximately 30%. And that is year over year. Now, this is really good because at the Apple event, they are supposedly going to kill Venmo because Venmo wouldn't be that important anymore when you had the Pay or the Apple Tap to Pay function. Apparently not so much because Venmo users are up 30% year over year, or the monthly active users. Now, if we look at the total payment volume mix across PayPal's payment platform, what's most important or what stands out the most is the 19% growth in the PSP. And this is, well, down quite substantially from prior quarters and prior. Q2 23, it was 28%. First quarter or the last quarter, it was up 26%, and now only 19%. Now, what they say is that this is consistent with the price to value strategy. PSP total payment volume decelerated from the first quarter, while Braintree contributions to total margin dollar growth improved. So they are sacrificing a bit of growth in order to stop giving pricing. And this is very positive because they were just giving away too much pricing. They wanted to stop that. They want to take pricing. And that might mean some slightly lower growth numbers, but better monetization, better profit growth instead of just revenues. Now we saw other merchant services that's also increasing more and more, and that now takes up about 10% of the total number. And when we look at the guidance once again, because this is from the investor presentation slide deck instead of just the initial numbers, we can see that the GAAP EPS now $3.88 to $3.98, where it was prior $3.65. But the free cash flow is now expected to be $6 billion instead of $5 billion. And this means that they are going to do share repurchases for $6 billion instead of $5 billion. So that is all very good, basically. That means more money returned to shareholders, and they are finally growing that free cash flow number again, because that has been stagnant for way too long. Now, again, if we look at the active accounts and mostly the monthly active accounts, because this is what I want to highlight. Now we are at 222 million monthly active accounts. And apart from the fourth quarter of 2023, where it was 224 million, well, we don't see any number that's higher than this number. So the monthly active accounts is just simply growing. And that's very positive. And when we look at the transaction margins, we see that the transaction margin is now only down 19 basis points compared to the year ago number. And this is the slowest deceleration that we have seen since 2021. This is probably what Alex Chris has been alluding to. It is up, 80 basis points since last quarter. Now, quarter to quarter shifts can be expected, but from a year ago, it's barely down. And they want to stabilize this number. That's one of the key priorities here. Now, let me know what you think about these earnings. I think they are very positive. And the last time I checked, the stock was up about 5%. I think it should be up way more on this number. There are a few things that are not as positive as others. But overall, I think this is a really good earnings release. So, thank you for watching. Please like and subscribe to my channel if you have enjoyed this video. And I hope to see you in my next one.